Welcome back, number crunchers. Today, we're kicking off our exploration of the Intermediate Accounting 15th edition slides, the brainchild of accounting legends Donald E. Tiso, Jerry J. Wiegand, and Terry D. Warfield. Now, these slides are knowledge bombs, but let's face it, sometimes accounting jargon can feel like a foreign language. That's where the fun part comes in. Joining me for this epic research quest is my trusty AI partner, Gemini. We're going to translate these slides into clear, understandable English, making intermediate accounting accessible and, dare I say it, even enjoyable. So, Gemini, fired up to unleash your accounting wisdom?
Absolutely, Ahmed. I've been analyzing these slides, and I'm ready to break down even the trickiest concepts into bite-sized pieces.
Awesome. Let's grab our metaphorical shovels and dig into Chapter 1, Financial Accounting and Accounting Standards. After studying this chapter, you should be able to identify the major financial statements and other means of financial reporting, explain how accounting assists in the efficient use of scarce resources, identify the objective of financial reporting, explain the need for accounting standards, identify the major policy-setting bodies and their role in the standard-setting process, explain the meaning of generally accepted accounting principles, GAAP, and the role of the codification for GAAP. Describe the impact of user groups on the rulemaking process. Describe some of the challenges facing financial reporting. Understand issues related to ethics in financial accounting. Financial statements and reporting. So Gemini, if we want to talk about essential characteristics of accounting, how can you explain them?
Here we can list the essential characteristics of accounting. These are: identification of financial information about economic entities, measurement of financial information about economic entities, communication of financial information about economic entities to interested parties. Economic entities can be any business or organization. Financial information includes things like a company's assets, liabilities, and profits. Interested parties include people who need to know about a company's financial health, such as investors, creditors, and managers. Accounting helps to ensure that financial information is reliable, relevant, and comparable. This means that users of financial information can trust that it is accurate and reflects the true financial condition of a company. It also means that they can compare the financial information of different companies to make informed decisions.
So, accounting identifies what's important financially, then measures it. But have you ever wondered how companies actually report that information?
Sure, it breaks down the process into different components. Financial information. This refers to the raw data about a company's financial activities. Accounting, this is the process of identifying, measuring, and communicating financial information. Accountants follow a set of rules called Generally Accepted Accounting Principles, GAAP, to ensure consistency and reliability in financial reporting. Financial statements, these are the formal reports that communicate a company's financial performance and position. The four main financial statements are: balance sheet, this shows a company's assets, liabilities, and shareholders' equity at a specific point in time. It's like a financial snapshot of the company on a particular date. Income statement, this reports a company's revenues and expenses over a period of time. It shows how much profit or loss the company made during that period. Statement of cash flows, this explains how cash moved in and out of the business during a period. Statement of changes in equity, this shows how much the owner's equity in the business changed over a period. Additional means of financial reporting, besides the financial statements, companies may also use other methods to communicate financial information. These include President's Letter, this is a letter from the company's president to shareholders that discusses the company's performance and future plans. Prospectuses, these are documents that companies provide to potential investors when they are raising capital. Reports filed with regulatory agencies, companies are required to file certain financial reports with government agencies, such as the Securities and Exchange Commission, SEC, in the United States. News releases, companies may issue press releases to announce important financial information, such as their quarterly earnings. Forecasts, companies may provide forecasts of their future financial performance. Note disclosures. These are additional details that provide more context to the financial statements. Environmental impact statements. These reports disclose a company's impact on the environment. And etc. This indicates that there may be other ways companies report financial information.
So Gemini, can you answer this question? What is the purpose of information presented in notes to the financial statements? To provide disclosure required by generally accepted accounting principles. To correct improper presentation in the financial statements. To provide recognition of amounts not included in the totals of the financial statements. To present management's responses to auditor comments.
Sure, I can answer the question. The purpose of the information presented in notes to the financial statements is to provide disclosure required by generally accepted accounting principles. Generally accepted accounting principles, GAAP, is a set of accounting standards that companies must follow when preparing their financial statements. The notes to the financial statements provide additional information that is not included in the main financial statements themselves, but is still important for understanding the company's financial position and results of operations. Here are some of the things that may be disclosed in the notes to the financial statements. Accounting policies. This explains the specific accounting methods that the company has used to prepare its financial statements. Significant estimates. This describes any estimates that the company has made in preparing its financial statements, such as the value of inventory or the amount of depreciation expense. Contingent liabilities. These are potential future obligations of the company that are uncertain in amount or timing. Related party transactions. These are transactions between the company and its affiliates, such as subsidiaries, joint ventures, or major shareholders. By disclosing this information in the notes, companies are able to provide a more complete and transparent picture of their financial health.
Understanding financial reporting is essential, but it gets even more interesting. The next slide shows how this information powers the engine of our economy. Let's explore how it all comes together. Financial reporting, users, and capital allocation.
This slide outlines a fundamental concept in finance and accounting: the interconnectedness of financial reporting, its users, and the broader economic function of capital allocation. Financial reporting. This refers to the process of communicating financial information about an entity to interested parties. This communication typically occurs through financial statements, balance sheet, income statement, cash flow statement, and statement of changes in equity, as well as other supplementary disclosures. Users of financial information. A diverse group of stakeholders relies on financial reports to make informed decisions. These users include investors, shareholders, potential investors, and analysts. Use financial information to assess a company's profitability, growth prospects, and investment value. Creditors, lenders, banks, and suppliers evaluate a company's financial health to determine creditworthiness and repayment ability. Management. Internal decision-makers use financial data for planning, controlling, and evaluating performance. Government. Tax authorities, regulatory agencies, and statistical bureaus utilize financial information for various purposes, including tax assessment, economic analysis, and policy formulation. Other users, employees, customers, competitors, and the general public may also have an interest in a company's financial performance. Capital allocation. This is the process of distributing financial resources among different investment opportunities. Financial reporting plays a crucial role in this process by providing the information necessary for investors, lenders, and other stakeholders to make informed decisions about where to allocate capital. Key takeaways. Financial reporting is a vital communication tool that connects businesses with a wide range of stakeholders. The quality and reliability of financial information directly impact the decision-making process of users, ultimately influencing capital allocation. Efficient capital allocation is essential for economic growth and development.
Let's see the audience if they can answer this question. An effective process of capital allocation is critical to a healthy economy, which promotes productivity, encourages innovation, provides an efficient and liquid market for buying and selling securities. All of the above. Okay, Gemini, what is your answer?
The answer is D. All of the above. An effective process of capital allocation is critical to a healthy economy because it promotes productivity by ensuring that resources are allocated to their most productive uses. It encourages innovation by providing the funds necessary for research and development. It provides an efficient and liquid market for buying and selling securities, which allows investors to easily diversify their portfolios and manage their risk. Accounting plays an important role in the capital allocation process by providing financial information that investors, lenders, and other stakeholders use to make informed decisions about where to allocate capital.
This slide we can say, investors are freaking out about accounting errors. Even small mistakes are causing huge drops in stock prices. This distrust is making it harder for companies to get money, and it's hurting the overall economy.
Sure, the slide discusses the importance of accounting in the efficient use of scarce resources. It states that investors are increasingly relying on accounting information to make decisions about where to allocate their capital. As a result, any accounting irregularities at a company can lead to a significant decline in the company's stock price. This is because investors are now more aware of the risks associated with investing in companies with questionable accounting practices. The slide also mentions that the cost of capital for companies has increased due to investor uncertainty. This is because investors are now demanding a higher return on their investment in order to compensate for the increased risk. As a result, companies have to pay more to borrow money, which can reduce their profitability. In short, the slide argues that relevant and reliable financial information is necessary for markets to be efficient. Accounting plays a crucial role in providing this information, and any accounting irregularities can have a significant impact on the economy. Here are some key points from the slide. Investors are increasingly relying on accounting information to make decisions. Any accounting irregularities at a company can lead to a significant decline in the company's stock price. The cost of capital for companies has increased due to investor uncertainty. Relevant and reliable financial information is necessary for markets to be efficient.
Overall, the slide highlights the importance of accounting in ensuring the efficient allocation of scarce resources in the economy. And what are the objectives of financial reporting?
The purpose of financial reporting is to provide financial information that is useful to present and potential equity investors, lenders, and other creditors in making decisions in their capacity as capital providers. Here's a more detailed explanation of the slide. Financial reporting is the process of communicating financial information about an entity to interested parties. The objectives of financial reporting are to provide information that is useful to investors, lenders, and creditors in making decisions about providing capital to the entity. Investors are people who own shares in a company. They use financial reporting to make decisions about whether to buy, sell, or hold their shares. Lenders are people or institutions that lend money to a company. They use financial reporting to assess the company's ability to repay its debts. Creditors are people or institutions that are owed money by a company. They use financial reporting to assess the company's ability to pay its debts. The information in financial reports is used by investors, lenders, and creditors to make decisions about how to allocate their capital. For example, investors may use financial reports to decide whether to invest in a company, and lenders may use financial reports to decide whether to lend money to a company.
So, this slide is for understanding the objectives of financial reporting. However, it is important to note that financial reporting is a complex process, and there are many other factors that can influence the decisions of investors, lenders, and creditors. Objective of financial accounting. This slide outlines the primary goal of financial accounting and the target audience for financial statements.
Yes, I can explain the key points. General-purpose financial statements. These are designed to provide financial information to a wide range of users. The focus is on delivering the most useful information possible while minimizing costs. Equity investors and creditors. These are the primary users of financial statements. Investors, shareholders, and creditors, lenders, rely on this information to make investment and lending decisions, respectively. Underlying concepts. While the primary focus is on investors and creditors, financial statements can also be beneficial to other stakeholders.
In essence, The main purpose of financial accounting is to produce financial statements that help investors and creditors make informed decisions about a company's financial health and performance. However, these statements can also be useful to other interested parties. And what about this slide, Gemini? How can you explain it?
The slide introduces the concept of an entity perspective. This means that in financial accounting, a company is treated as a separate and distinct entity from its owners. This separation is crucial for accurate financial reporting because it allows for the clear identification of the company's assets, liabilities, and equity, without mixing them with the personal finances of the owners. Decision usefulness. The primary goal of financial accounting is to provide information that is useful for decision-making. The slide specifically mentions investors as the primary users of financial statements. Investors are interested in two main things. Ability to generate net cash inflows. Investors want to know if the company can generate cash to return to them in the form of dividends or through the sale of their shares. Management's ability to protect and enhance capital providers' investments. Investors are interested in how well management is using their invested capital to generate profits and grow the company. Essentially, financial accounting aims to provide information that helps investors assess a company's profitability, liquidity, and financial stability.
In summary, financial accounting treats a company as a separate entity from its owners. This means the company's finances are kept distinct from the owner's personal finances. The main goal is to provide information that helps investors assess the company's ability to generate cash and protect their investment.
This slide emphasizes the stewardship role of management in addition to providing information about future cash flows. Key points. Stewardship responsibility. Management is accountable to investors not only for generating future cash flows but also for safeguarding and efficiently utilizing the company's resources. This includes protecting assets from economic, technological, and social risks. Linked to cash flows. A company's ability to generate cash flows is often influenced by how well management fulfills its stewardship responsibilities. For instance, effective management of resources can lead to cost savings, increased efficiency, and ultimately, improved cash flows. Decision useful information. Financial reporting should provide information to help investors assess management's performance in both generating cash flows and fulfilling its stewardship role.
In essence, investors are interested in not only a company's profit-making ability but also how well management is taking care of their investment. Financial reporting should provide insights into both aspects to help investors make informed decisions. Here we will talk about the need to develop standards.
This slide effectively illustrates the fundamental reason for developing accounting standards. Key points. Diverse user needs. Various individuals and entities, such as investors, creditors, and government agencies, rely on financial information for decision-making. Financial statements. These are the primary tools for communicating financial information. They include the balance sheet, income statement, statement of stockholders' equity, statement of cash flows, and accompanying notes. Inconsistency problem. Without standardized guidelines, companies could prepare financial statements in different ways, making comparisons and evaluations difficult for users. GAAP solution. To address this issue, the accounting profession developed generally accepted accounting principles, GAAP, to establish consistent and comparable financial reporting practices.
So we can say that accounting standards like GAAP are necessary to ensure that financial information is reliable, comparable, and useful for various stakeholders. Without these standards, the financial statements produced by different companies would be like apples and oranges, making it impossible to draw meaningful comparisons. Now Gemini will tell you about parties involved in standard setting.
Sure, where we have a list of 3 organizations involved in setting accounting standards in the United States. Securities and Exchange Commission (SEC). The SEC is a government agency that oversees the securities industry and enforces federal securities laws. It has the authority to establish accounting standards for publicly traded companies. American Institute of Certified Public Accountants (AICPA). The AICPA is a professional organization for certified public accountant CPAs. It develops and promotes auditing and accounting standards, and it represents the interests of CPAs to the SEC and other standard-setting bodies. Financial Accounting Standards Board (FASB). The FASB is a private sector organization that is responsible for establishing most of the accounting standards used in the United States. It is overseen by the Financial Accounting Foundation, FAF, which is funded by the accounting profession.
In other words, the SEC, AICPA, and FASB all play important roles in the standard-setting process. The SEC has the ultimate authority to establish accounting standards, but it often delegates this responsibility to the FASB. The AICPA represents the interests of the accounting profession and provides input to the FASB on proposed accounting standards.
The standard-setting process is complex and ongoing. The SEC, AICPA, and FASB are constantly working to improve the accounting standards used in the United States. Here is a clear overview of the Securities and Exchange Commission, SEC's role in establishing and overseeing accounting standards for public companies in the United States. Key points. Established by federal government, the SEC is a government agency created to regulate the securities industry. Focus on public companies. The SEC's primary concern is accounting and reporting standards for companies whose securities are traded publicly. Legal basis. The Securities Act of 1933 and the Securities Act of 1934 provide the legal framework for the SEC's authority. Encouraging private standard setting. While the SEC has the power to set standards, it has primarily encouraged private organizations like the FASB to develop accounting standards. GAAP adherence. The SEC mandates that public companies adhere to generally accepted accounting principles, GAAP. Oversight and enforcement. The SEC oversees the standard-setting process and has the authority to enforce compliance with accounting standards. In essence, the SEC is the primary regulator of public companies in the United States, including their financial reporting. While it has the power to set accounting standards, it has delegated much of this responsibility to private organizations like the FASB. The SEC's role is to ensure that public companies adhere to GAAP and to protect investors by maintaining fair and efficient markets. Here, this slide provided outlines the AICPA's role in establishing accounting standards in the United States. Key points. AICPA as a professional organization. The AICPA is a national professional organization representing certified public accountants, CPAs. Early standard-setting efforts. Committee on Accounting Procedures, CAP formed in 1939, the CAP issued accounting research bulletins, ARBs, to address accounting issues on a case-by-case basis. This approach proved to be ineffective due to its inconsistency. Accounting Principles Board, APB established in 1959, the APB replaced the CAP with the aim of developing a comprehensive set of accounting principles. It issued Accounting Principles Board Opinions, APBOs. However, it also faced challenges in establishing a coherent framework. Wheat Committee and the Path Forward. Recognizing the limitations of the APB, the Wheat Committee was formed in 1973. Its recommendations led to the creation of the Financial Accounting Standards Board, FASB, in 1973, marking a significant shift in the standard-setting process. In essence, the AICPA, through its CAP and APB, played a crucial role in the early development of accounting standards in the United States. While their efforts were valuable, they ultimately paved the way for the establishment of the FASB, which became the primary standard-setting body. This slide outlines the primary organizations involved in setting accounting standards in the United States. Financial Accounting Standards Board, FASB. The FASB is the primary standard-setting body for accounting standards in the U.S. It was created following recommendations from the Wheat Committee. Its primary function is to establish and improve standards of financial accounting and reporting. Financial Accounting Foundation, FAF. The FAF oversees the FASB. It selects members of the FASB, funds their activities, and exercises general oversight. Financial Accounting Standards Advisory Council. The FASB Advisory Council consults on major policy issues related to accounting standards. Essentially, the FASB sets the accounting standards, the FAF oversees the FASB, and the Advisory Council provides input to the FASB. This structure ensures a balance between the standard-setting body, its overseer, and input from various stakeholders in the accounting industry. We can compare here the Financial Accounting Standards Board, FASB, to its predecessor, the Accounting Principles Board, APB. Key differences. Smaller membership. The FASB has a smaller number of members compared to the APB, allowing for more focused decision-making. Full-time, remunerated membership. FASB members are full-time employees and receive compensation, ensuring dedication and expertise. Greater autonomy. The FASB operates with more independence from other organizations, reducing potential conflicts of interest. Increased independence. FASB members have stronger independence, reducing potential pressures from various stakeholders. Broader representation. The FASB aims to include a wider range of perspectives in its standard-setting process. In essence, the FASB was designed to be a more effective and independent standard-setting body compared to the APB. These changes were intended to improve the quality and consistency of accounting standards.
Thank you, Gemini, for this comprehensive explanation. Let me see if the viewers can answer this question. The first step taken in the establishment of a typical FASB statement is: the board conducts research and analysis and a discussion memorandum is issued. A public hearing on the proposed standard is held. The board evaluates the research and public response and issues an exposure draft. Topics are identified and placed on the board's agenda. Hey Gemini, would you please answer this question?
Sure. The correct answer is D. Topics are identified and placed on the board's agenda. Here's a breakdown of the FASB's standard-setting process. Agenda selection. The FASB identifies accounting issues that need to be addressed and prioritizes them for further research. Research and analysis. The board conducts in-depth research and analysis of the issue, including gathering input from various stakeholders. Discussion memorandum. The FASB issues a discussion memorandum, which outlines the preliminary views of the board on the issue and seeks public comment. Public hearings. The FASB holds public hearings to gather additional input from interested parties. Exposure draft. The board evaluates the research, public comments, and hearing feedback to develop an exposure draft, which presents the proposed accounting standard. Final standard. The FASB considers public comments on the exposure draft and issues a final accounting standards update, which establishes the new accounting standard.
That's good, Gemini. Can you please explain this illustration?
Sure. The illustration talks about the FASB's due process system, which is the process that the Financial Accounting Standards Board, FASB, follows to develop new accounting standards. The FASB is a private sector organization that is responsible for establishing most of the accounting standards used in the United States. The FASB's due process system is a comprehensive and transparent process that includes the following steps. Topic identification and agenda selection. The FASB identifies accounting issues that need to be addressed and prioritizes them for further research. Research and analysis. The FASB conducts in-depth research and analysis of the issue, including gathering input from various stakeholders. Preliminary views and exposure draft. The FASB issues a discussion memorandum, which outlines the preliminary views of the board on the issue and seeks public comment. Public hearings. The FASB holds public hearings to gather additional input from interested parties. Exposure draft. The FASB evaluates the research, public comments, and hearing feedback to develop an exposure draft, which presents the proposed accounting standard. Final standard. The FASB considers public comments on the exposure draft and issues a final accounting standards update, which establishes the new accounting standard. The FASB's due process system is designed to ensure that the accounting standards that are developed are high quality and meet the needs of all users of financial statements. The system is also designed to be transparent and open to public input. The FASB's due process system is one of the most rigorous and transparent standard-setting processes in the world. It is a model for other standard-setting organizations around the world.
In this slide we can see the types of pronouncements. Can you tell me what does that mean?
The slide focuses on the Financial Accounting Standards Board, FASB, and the types of pronouncements it issues. FASB is the primary standard-setting body for accounting standards in the United States. It establishes and improves standards of financial accounting and reporting for public and private companies. Types of pronouncements. Accounting Standards Updates ASUs. These are the primary source of new GAAP and amendments to existing GAAP. They are considered authoritative literature. Financial Accounting Concepts Facts. These statements provide a conceptual framework for understanding and applying accounting standards. They are not considered authoritative literature but serve as a basis for developing GAAP. An example of a financial accounting concept statement is Statement of Financial Accounting Concepts Number 6, which defines the elements of financial statements, assets, liabilities, equity, revenues, expenses, gains, and losses.
So, we can say that the slide highlights the two main types of pronouncements issued by the FASB: accounting standards updates for specific accounting rules, and financial accounting concepts for the underlying framework of financial accounting. Let's talk about Generally Accepted Accounting Principles, GAAP. This slide provides a concise overview of GAAP and its primary sources.
Yes, GAAP stands for Generally Accepted Accounting Principles. These are a set of accounting standards, rules, and procedures that guide how financial statements are prepared and presented in the United States. GAAP ensures consistency and comparability in financial reporting. Key points. Substantial authoritative support. GAAP principles are widely accepted and supported by the accounting profession. Major sources of GAAP. FASB standards, interpretations, and staff positions. The Financial Accounting Standards Board, FASB, is the primary standard-setting body in the U.S., and its pronouncements are the most authoritative source of GAAP. APB opinions, issued by the Accounting Principles Board, a predecessor to the FASB. These opinions are still considered GAAP, but they are less authoritative than FASB standards. AICPA, Accounting Research Bulletins, issued by the American Institute of Certified Public Accountants, AICPA. These bulletins were early attempts at standard setting and are still considered GAAP, but their authority is limited compared to FASB standards.
So, we can say that the slide highlights that GAAP is a body of authoritative literature, with FASB standards being the most significant component. While APB opinions and AICPA accounting research bulletins are still part of GAAP, their influence is generally superseded by FASB pronouncements.
This illustration provides a visual representation of the various documents and sources that contribute to Generally Accepted Accounting Principles, GAAP. Key components. GAAP documents. These are the primary sources of accounting guidance and standards used in the United States. Hierarchy of GAAP. The illustration suggests a hierarchy, with FASB standards, interpretations, and staff positions being the most authoritative, followed by APB opinions, AICPA, accounting research bulletins, and other sources. Diverse sources. GAAP is derived from a combination of documents issued by different organizations, including the FASB, AICPA, and other bodies. Complementary role. While the FASB is the primary standard setter, other sources provide additional guidance and support for specific industries or accounting issues. In essence, the illustration emphasizes the complex nature of GAAP, which is composed of multiple layers of authoritative literature. It highlights the importance of understanding the hierarchy of these documents when applying accounting principles to specific situations.
Excuse me, Gemini. Before we answer this question, let me tell our audience that you can see more multiple choice questions in my channel and the link is in the description. Here is the question. Which of the following accounting pronouncements is the most authoritative? FASB Statement of Financial Accounting Concepts, FASB Technical Bulletins, AICPA Accounting Principles Board Opinion, AICPA Statement of Position. Okay, Gemini, what's your answer?
The answer to the question is A. FASB Statement of Financial Accounting Concepts. FASB Statements of Financial Accounting Concepts are the most authoritative accounting pronouncements because they provide the foundation for understanding and applying accounting standards. They establish the objectives and concepts that underlie GAAP. while other pronouncements, such as FASB Technical Bulletins, AICPA Accounting Principles Board Opinions, and AICPA Statements of Position, provide more specific guidance on accounting issues. They are based on the foundational concepts established by the FASB Statements of Financial Accounting Concepts. Now let's see this slide. This one is about the meaning of Generally Accepted Accounting Principles, GAAP, and the role of the codification for GAAP. It says that GAAP is a set of rules and standards that are used to prepare financial statements. The codification is a database that contains all of the GAAP rules in one place. The slide also says that there is a debate about whether GAAP should be based on principles or rules. Principles-based standards would give accountants more flexibility in how they apply the standards, while rules-based standards would be more specific and prescriptive. The current GAAP standards are based on a mix of principles and rules. The SEC, which is the agency that oversees the financial markets, has said that it is important for accountants to use judgment when applying GAAP. This means that accountants should not just blindly follow the rules, but should also consider the economic substance of the transaction. The slide concludes by saying that the goal of GAAP is to produce high-quality financial statements that are relevant and reliable. The codification is a valuable resource for accountants, but it is important to remember that it is just a starting point. Accountants should also use their judgment and experience when applying GAAP.
This slide is about the Generally Accepted Accounting Principles, GAAP, and the FASB codification.
GAAP is a set of rules and standards that are used to prepare financial statements. The codification is a database that contains all of the GAAP rules in one place. The goal of the codification is to provide in one place all the authoritative literature related to a particular topic. This means that accountants can find all of the relevant GAAP rules for a particular topic in one place, without having to search through multiple sources. The codification also creates one level of GAAP, which is considered authoritative. This means that the codification is the only source of authoritative GAAP rules. All other accounting literature is considered non-authoritative. The FASB has developed the Financial Accounting Standards Board Codification Research System, CRS. CRS is an online real-time database that provides easy access to the codification. This means that accountants can access the codification from anywhere with an internet connection. The codification is a valuable resource for accountants. It provides a comprehensive and up-to-date source of GAAP rules. By using the codification, accountants can be sure that they are applying the correct GAAP rules to their financial statements.
This illustration reviews FASB codification framework. What can you tell us about it?
Yes, this illustration provides a visual representation of the structure of the FASB codification. The codification is a database that organizes all generally accepted accounting principles, GAAP, into one place. Here's a breakdown of the structure. Topic: a broad category of accounting guidance. Example: receivables, leases. Subtopics: a subset of a topic, categorized by type or scope. Example: troubled debt restructurings, overall restructurings, both under receivables topic. Sections: indicate the type of content within a subtopic. Example: initial measurement, subsequent measurement. Paragraphs: contain the actual accounting guidance or rules. This is where you'll find the specific information you're looking for.
Thank you, Gemini. We can say, in other words, the codification is structured like a library, with topics, subtopics, sections, and paragraphs serving as a roadmap to find the specific accounting information you require. This slide is about the Generally Accepted Accounting Principles, GAAP, and the different user groups that influence the formulation of accounting standards. What do you think, Gemini?
The main point of the slide is that GAAP is as much a product of political action as it is of careful logic or empirical findings. This means that the accounting standards that are used to prepare financial statements are not just based on technical considerations, but are also influenced by the interests of different groups of people. The different user groups that influence the formulation of accounting standards include business entities. These are the companies that prepare financial statements. They have an interest in accounting standards that are easy to apply and that do not impose undue burdens on them. CPAs and accounting firms. These are the professionals who prepare and audit financial statements. They have an interest in accounting standards that are clear and concise, and that can be applied consistently. Financial community, this includes analysts, bankers, and other investors. They have an interest in accounting standards that provide them with relevant and reliable information about the financial performance of companies. Preparers, this includes financial executives and other people who are involved in preparing financial statements. They have an interest in accounting standards that are easy to apply and that do not require them to disclose too much proprietary information. Government, this includes the Securities and Exchange Commission, SEC, the Internal Revenue Service, IRS, and other government agencies. They have an interest in accounting standards that protect investors and ensure that companies are paying their fair share of taxes. Industry associations, these are groups that represent the interests of specific industries. They have an interest in accounting standards that are tailored to the needs of their members. The Financial Accounting Standards Board, FASB, is the body that is responsible for setting accounting standards in the United States. The FASB is influenced by all of the user groups that I mentioned above. When the FASB is developing a new accounting standard, it considers the interests of all of these groups and tries to find a balance that meets the needs of everyone. The slide also says that the goal of GAAP is to produce high-quality financial statements that are relevant and reliable. However, the political nature of the standard-setting process can sometimes make it difficult to achieve this goal. For example, some accounting standards may be influenced by special interests, and this can lead to standards that are not as relevant or reliable as they could be.
Overall, the slide shows that the formulation of accounting standards is a complex process that is influenced by a variety of factors. The FASB has a difficult job to do in trying to set standards that meet the needs of all of the different user groups.
The slide here is about the impact of user groups on the rulemaking process for fair value accounting. It discusses the debate over the use of fair value accounting for financial assets, and how this debate has been influenced by different user groups. The slide states that fair value accounting provides the most relevant and reliable information for investors about financial assets and liabilities. However, in the wake of the recent credit crisis, some countries, central banks, and bank regulators want to suspend fair value accounting. They are concerned that using fair value accounting, which would require recording significant losses on poorly performing loans and investments, could scare investors and depositors and lead to a run on the bank. The slide also mentions that in 2009, Congress ordered the FASB to change its accounting rules so as to reduce the losses banks reported, as the values of their securities had crumbled. This shows how political pressure can influence the rulemaking process for accounting standards. The different user groups that have influenced the debate over fair value accounting include banks. Banks generally support fair value accounting because it provides a more accurate picture of their financial condition. However, they have lobbied for changes to the rules during times of financial stress, arguing that fair value accounting can lead to excessive volatility in their reported earnings. Investors generally support fair value accounting because it provides them with more relevant and reliable information about the value of their investments. However, some investors have expressed concerns that fair value accounting can be manipulated by banks and other companies. Standard setters, the FASB and IASB are the standard-setting bodies responsible for developing accounting standards. They are influenced by the interests of all of the user groups, and they must balance the need for relevant and reliable information with the need for stable and predictable financial reporting. Governments can also influence the rulemaking process for accounting standards. For example, the U.S. government ordered the FASB to change its accounting rules for fair value accounting in 2009. The slide concludes by saying that the debate over fair value accounting is a complex issue with no easy answers. The different user groups have different interests, and the standard setters must find a way to balance these interests while developing accounting standards that are relevant, reliable, and stable. Overall, the slide shows that the rulemaking process for accounting standards is a political process that is influenced by a variety of factors, including the interests of different user groups. This slide is about the challenges of achieving convergence in international accounting standards. It states that one of the main difficulties is that countries have different cultures and customs, which are reflected in their accounting practices. The former chair of the IASB, Sir David Tweedy, illustrated this point by comparing the accounting cultures of different European countries. He said that in the UK, everything is permitted unless it is prohibited. In Germany, the opposite is true, everything is prohibited unless it is permitted. In the Netherlands, everything is prohibited even if it is permitted. And in France, everything is permitted even if it is prohibited. This diversity of thinking around the world makes it difficult to develop a single set of accounting standards that can be applied consistently across all countries. The slide concludes by saying that this is why accounting convergence has been so elusive.
The slide here provided discusses the expectation gap in financial reporting. What is the expectation gap?
The expectation gap refers to the difference between what the public expects accountants and auditors to do and what accountants and auditors actually can or are required to do. In simpler terms, it's the mismatch between public perception and the reality of financial reporting. Key points from the slide. The gap is difficult to close. Due to various factors, including accounting scandals, there's a persistent difference between public expectations and the actual capabilities of accountants. Accounting scandals, high-profile accounting scandals have significantly contributed to the widening of the expectation gap. These scandals have eroded public trust in financial reporting. Sarbanes-Oxley Act, SOX. This act was passed in response to accounting scandals to increase corporate responsibility and accountability. It aimed to improve financial reporting by enhancing corporate governance and oversight. Public Company Accounting Oversight Board, PCAOB, established by SOX, the PCAOB oversees the audits of public companies in the United States. It was created to add an extra layer of oversight to the auditing profession. Implications of the expectation gap. The expectation gap can lead to several issues. Loss of public trust. When the public believes accountants are not fulfilling their responsibilities, it can erode trust in financial markets and the economy as a whole. Increased litigation. Lawsuits against accountants and auditors may rise if the public feels misled or harmed by financial statements. Regulatory burden. To address public concerns, regulators may impose stricter rules and regulations, increasing the cost of compliance for companies.
So, the slide highlights the challenge of aligning public expectations with the realities of financial reporting and the role of regulatory bodies in addressing this issue. Here we can outline several key challenges that financial reporting faces. These challenges are grouped under the broader category of financial reporting challenges. Can you tell me please what are challenges in financial reporting?
Financial reporting challenges are non-financial measurements. Traditional financial statements primarily focus on monetary values. However, there's a growing demand for incorporating non-financial metrics, like customer satisfaction, environmental impact, or employee morale, to provide a more comprehensive view of a company's performance. Forward-looking information. Financial statements are historical documents. There's a desire to include more forward-looking information, like forecasts, projections, or management plans, to help investors assess a company's future prospects. Soft assets. Assets like intellectual property, brand reputation, and human capital are increasingly valuable but difficult to quantify and report on in traditional financial statements. Timeliness. Financial reporting often occurs after significant events, reducing its relevance for decision-making. There's a push for more timely reporting to provide up-to-date information. Understandability. Financial statements can be complex and difficult for non-financial users to understand. Improving the clarity and readability of financial reports is essential for effective communication.
Here we can say, this slide highlights the need for financial reporting to evolve to meet the changing needs of stakeholders. It emphasizes the challenges of incorporating non-financial information, providing forward-looking insights, and accurately valuing intangible assets. Additionally, the importance of timely and understandable reporting is underscored.
This slide presents a key issue in financial reporting, the existence of multiple sets of accounting standards used globally. It highlights the two primary standards. U.S. GAAP, Generally Accepted Accounting Principles issued by the Financial Accounting Standards Board, FASB, and primarily used in the United States. IFRS, International Financial Reporting Standards issued by the International Accounting Standards Board, IASB, and used by most countries outside the US. The challenge of multiple standards. The existence of these two major sets of standards creates challenges for international businesses and investors. Companies operating in multiple countries must comply with different accounting rules, increasing complexity and costs. Similarly, investors comparing companies from different countries face difficulties due to the lack of consistent financial reporting standards. The potential benefits of IFRS adoption. The slide also mentions a potential solution: the adoption of IFRS by U.S. companies. This would lead to easier comparison. Investors could more easily compare financial performance and position of U.S. and foreign companies. Facilitated capital raising. U.S. companies could potentially access capital from international markets more easily. Conclusion. The slide emphasizes the complexities arising from multiple accounting standards and introduces the idea of IFRS adoption as a potential solution to enhance global comparability and efficiency in financial reporting. This slide is about the ethics in financial accounting. It states that in accounting, we frequently encounter ethical dilemmas. GAAP does not always provide an answer to these dilemmas, and doing the right thing is not always easy or obvious.
Phew. That was a whirlwind tour of Chapter 1, but hopefully, it helped shed some light on financial accounting and the importance of those oh-so-important accounting standards. Huge thanks to Gemini for all his insights. You're a true accounting whiz. Listen up, number enthusiasts. This video took some serious editing magic, so if you'd like me to tackle the rest of the intermediate accounting slides with Gemini, let me know in the comments below. Don't forget to smash that subscribe button to join the accounting adventure train. Until next time, keep those calculators clicking and those debits and credits flowing.